Two of the biggest names in the US banking, Morgan Stanley and Wells Fargo, they just reported their earnings last week. One is cashing in on market volatility and wealth management. The other is making a quiet comeback through cost control and stronger credit. But the real question is, which one is a better investment right now? In this video, we are using real market data and AI insights to compare them side by side, from their financial strengths to valuation trends and price actions. All data is from AlphaStock AI. The link is down below. Here is a quick comparison between Morgan Stanley and Wells Fargo. As you can see, Morgan Stanley is showing a stronger earning performance and looks slightly more expensive based on its valuation, but that's backed up by its better profitability. Both stocks are currently trading below their 50 moving averages, which points to a neutral trend for now. Now let's head to their most recent earnings one by one and see what are their highlights and how that impact our investment. Let's look at Morgan Stanley earnings first. That was published last week on April 11th, 2025. So on the high level, it has a strong performance. Morgan Stanley reported a record revenue of $17.7 billion and EPS of 2.6 in last quarter, with a robust return on tangible common equity of 23%. That is a very strong quarter. A 23% return shows they are using investor money very well and making solid profits. The wealth management added $94 billion in the net new assets, achieving a 6% annualized growth rate. This is a steady and healthy growth. Wealth management brings in stable income, which helps the company stay strong even in tough market. Equities and institutional securities. Record equities revenue of $4.1 billion, up 45% year to year, driven by strong clients' activity and market volatility. This 45% jump is huge. It means they made the most of market swings and handled a lot of trading for clients. Capital and financial strengths. The CET1 ratio, which is a common equity tier 1 ratio, that is a bank's most solid capital, such as common shares and retained earnings. The CET1 ratio is at 15.3%, showcasing a strong capital position and financial flexibility. This is a solid safety cushion. It gives them room to handle risks and investment when needed. Sentiment and future direction. Cautiously optimistic. Despite the macroeconomic uncertainties, Morgan Stanley remains positive about its ability to navigate market volatility and continue delivering strong results. That means they know the economy is shaky but feel ready to handle it. That's a good sign of confidence and preparation. Focus on long-term strategy. Emphasis on raising, managing, and allocating capital with a commitment to client engagement and global reach. So that means they are focused on building for the future and staying connected with their clients around the world. Investment banking outlook. While some clients are pausing due to the uncertainty, the firm believes in the resilience of its investment banking pipeline. So that means deals are slow right now, but they believe business will pick up again. That's normal in times of uncertainty. Investment recommendations. Positive outlook. Morgan Stanley's strong financial performance and a strategic focus make it a favorable investment, particularly for those seeking exposure to financial service with a robust wealth management component. That means it's a strong pick for investors who look for both growth and stability, especially with its focus on managing client money. There are still some areas of concerns. Monitor macroeconomy uncertainties, which we know already, including the potential impacts from the merger and acquisition and IPO activities, which could affect future earnings. That tells the investors to watch out for slower deal making if the economy stays uncertain. It might hurt the short-term results. Watch for regulatory changes. The potential reforms in capital requirements could impact the firm's balance sheet management and capital deployment strategies. So there might be some new rules that could limit how they use money for things like a buyback or dividends. That is something investors should keep an eye on. The final comment, Morgan Stanley had a great quarter with strong results, steady asset growth, and a smart long-term plan. It's a solid name to watch, especially if markets stay bumpy. Let's now look at Wells Fargo earnings, which was published also last week on the same day as Morgan Stanley. On the high-level summary, the earning growth diluted EPS increased by 16% year-to-year, driven by disciplined expense management and a strategic revenue diversification. That's a solid earning boost. Controlling costs while growing different revenue sources shows strong management and a balanced business model. Revenue mix. Fee-based revenue growth offset a decline in net interest income, showcasing successful diversification efforts. This is important. It means Wells Fargo isn't just relying on interest income from loans. More fee income makes earnings more stable and less tied to interest rate swings. Capital management returned $4.8 billion to shareholders, average common shares down 8% year to year. Returning that much capital is a strong signal. Fewer shares also mean higher earnings per share. That's good news for investors. Credit performance improved credit discipline with lower net charge-offs and stable consumer losses. Credit quality is holding up well. Fewer bad loans means less risk and shows customers are generally able to repay their debts. Regulatory progress closed 5 consent orders indicating significant progress in risk management. This is a big step forward. It shows Wells Fargo is cleaning up past issues and rebuilding trust with regulators and investors. Sentiment and future direction. Positive sentiment. Management expressed confidence in strategic priorities and future growth potential. That tells investors that management seems upbeat, which suggests they believe their plan is working and they are on the right track for growth. Cautious outlook acknowledged economic uncertainties but highlighted strong customer financial positions and resilience. That means they are being realistic, even with economic risks and uncertainties, but they think their customer base is solid and can weather a slowdown. Strategic investments. Continued focus on growing fee-based business and enhancing digital and branch experience. Investing in digital tools and fee services is smart. It keeps them competitive and helps bring in more reliable income. Then comes to the investment recommendations. It's a buy recommendation. Strong earnings growth, improved credit performance, and a strategic revenue diversification makes Wells Fargo an attractive investment. Overall, it's a solid pick. They are improving in all the right areas and building a safer, more balanced business. There are still some areas of concerns, such as economic uncertainties and potential regulatory changes could impact future performance. Watch for further progress on consent order closures and clarity on economic policies affecting growth. So investors should keep an eye on how they continue fixing past issues and how upcoming policy decisions might impact their business. Then it comes to the final comment. Wells Fargo is showing real improvement, better earnings, stronger credit, and a focus on long-term growth make it a name worth watching. So overall, when we compare the two banks, Morgan Stanley had big gains from trading and wealth management with strong profits. Wells Fargo grew earnings by cutting costs and making more from fees. So Morgan Stanley is strong in markets and investing, while Wells Fargo is improving loans and fixing past problems. So both are doing well, but focus on different things. Now let's look at their valuation to see which one is overvalued or undervalued. Let's look at their price to book ratio. Morgan Stanley's price to book ratio stayed higher than Wells Fargo ending at 1.9 versus 1.3 in the latest quarter. That means investors are paying a little bit more for each dollar of Morgan Stanley book value, showing stronger market confidence in Morgan Stanley. And the price multiple, Morgan Stanley had a higher and a more jumpy enterprise value numbers, but in the last quarter, it dropped sharply, likely due to the data glitch or big market move. Wells Fargo stayed steadier, finishing at 47.5, showing more predictable market pricing. On the PE ratio, Morgan Stanley PE ratio ranged from about 11 to 24, while Wells Fargo stayed lower and more stable, around 6.5 to 13. This means Morgan Stanley often trades at a premium, but Wells Fargo is seen as a better value in terms of earnings. And Morgan Stanley price to sales ratio was consistently higher, finishing at 12.4, while Wells Fargo caught up lately at 12.1. So that means both are now valued similarly based on sales, but Morgan Stanley kept a premium most of the time. On their price to cash flow and free cash flow, here is where it gets messy. Both had big ups and downs. Morgan Stanley hit 94.4, while Wells Fargo dropped as low as minus 209. These wild swings suggest cash flow stability is a concern for both, but especially for Wells Fargo. Quick summary, Morgan Stanley looks more expensive across most metrics, which usually means the market has higher expectations. Wells Fargo is cheaper but more stable in some areas like PE ratio and enterprise values. So what does it tell investors? If you want a bank stock with big potential but some ups and downs, Morgan Stanley might be for you. If you prefer a steadier ride with cheaper pricing, Wells Fargo could be a safer bet. Now let's look at their technical charts. Morgan Stanley and Wells Fargo, both of them had sharp sell-offs from March to April, each dropping over 25%. Morgan Stanley bounced from 95 to 109, but is still struggling at 112, resistance with weakening volume. Wells Fargo fell from 80 to 59 and rebounded to 64, but remains under pressure near resistance at 66. Morgan Stanley shows a slightly stronger recovery pattern, while Wells Fargo trades more heavily and looks weaker technically. Both stocks face uncertain long-term trends, with their key support near recent lows. Morgan Stanley appears more resilient short-term, but neither of them has confirmed the bullish reversal yet. So investors should watch volume and resistance zones closely. Okay, that covers everything in today's video. Let me know in the comments below whether you are leaning toward Morgan Stanley's market-driven strength or Wells Fargo's steady recovery. AlphaStock AI is always here, helps you to compare, analyze, invest smarter. Head over to alphastockai.com for deeper insights, interactive charts, and personalized stock analysis. If you found this breakdown helpful, make sure to like, subscribe, and hit the bell button so you don't miss the next analysis. Thanks for watching. I will see you in the next one.